Hi, Mike L. Mahler, recovering CPA, back with another lesson in this mercifully brief introduction to financial accounting. In the previous lesson, I introduced the fundamental accounting measurement framework, the accounting equation, the teeter-totter, and the balance sheet. In this lesson, we take a closer look at the equity side of the framework, which includes revenue and expenses. I'll show how revenue and expenses impact assets and liability, and we'll explore the close relationship between a business's economic condition and its economic performance. Let's return to the fundamental accounting equation. The equity part of our accounting framework consists of three subcategories. First is changes in equity that occur when the owner contributes to or draws money from the business. But such transactions are relatively infrequent. More frequently, changes in equity occur through the earning of revenue and incurring expenses, the other two subcategories of equity. A business generates revenue when it exchanges goods or services with its customers in return for money or other assets. A business incurs expenses by exchanging its assets for goods and services it needs to generate revenue. In generating revenue and expenses, assets and liabilities are always impacted since the teeter-totter must always remain in balance. For example, if a business renders a service in exchange for cash, an asset, cash, increases. To keep the teeter-totter in balance, either the liability or the equity side must increase by an equal amount. But in selling services, no liability is incurred, so this means that equity must increase. An increase in revenue must lead to an increase in equity. Similarly, if a business incurs a cash expense, an asset, cash, has decreased, so the other side of the accounting teeter-totter must decrease as well. Because paying cash to meet an expense is not equivalent to paying off a debt, there is no decrease in liability, so the incurring of an expense must be accompanied by a change in equity. In fact, all incurred expenses lead to reductions in equity. This table illustrates the subaccount structure of the accounting teeter-totter. Just as there are subcategories of assets and liabilities in equity, there are numerous subcategories of revenue and expense. This brings us to the relationship between the economic condition of a business and its economic performance. A business is performing well if it realizes net income or profit. Profit occurs only if its revenues exceed expenses. If its expenses exceed revenue, the business incurs a loss. Revenues earned and expenses incurred are central to the question of economic performance. Did the firm do well, make a profit, or do badly, incur a loss? Now, even though revenue and expense transactions change equity, the detailed changes in revenue and expense account balances are not reflected in the owner's equity section of the balance sheet as you might expect. Instead, revenues and expenses are reflected in a separate fundamental report called the income statement. Sometimes the income statement is referred to as the profit and loss statement or simply the P&L. The equity section of the balance sheet will show the owner's contributions, the owner's withdrawals, and the aggregate profit and loss for the accounting period. Good performance generates a good economic condition. Profits generate assets, losses eat up assets, and generate liabilities. So let's look at an example of some typical transactions for this business. Mort Thanatopoulos, a licensed mortician, has decided to open a funeral home specializing in very low-cost funerals. The business will be called Can You Dig It? Here is a list of Mort's cash transactions during his first month. This table illustrates the effect of these transactions on the fundamental accounting equation. Notice that the basic accounting equation is maintained after each transaction. In the first transaction, an asset is increased by $5,000 while equity increases by the same amount. In some transactions, like the second, only one side of the equation is changed. One asset, cash, decreased, while another asset, funeral supplies, increased by the same amount. In the third transaction, cash increased and so did a liability in the same amount. The final four transactions involve revenue and expenses, which are increases and decreases in equity. The revenue transaction increased both cash and equity by the same amount. The expenses decreased both asset and equity by the same amount. These transactions and the final account balances lead to the following simple balance sheet and income statement. Before closing, I want to emphasize that revenue includes only assets received from customers or clients in exchange for goods and services. Cash received as loans from creditors or as contributions from donors are not revenues. Similarly, the disbursement of cash to repay loans or make distributions to the owners are not expenses. So click here for the next lesson.